To many people, this is the real guts of finance, risk and return. We're going to be talking about how risk affects the return that is required, and most of the concepts, the theories presented in this particular unit are aimed at explaining equity returns. In other words, the return to the stock in the stock market. So if you've ever wanted to be a stock analyst, here's your opportunity, I guess. What are investment returns? Investment returns are a measure of the financial results of any kind of investment. Returns can either be historical, what actually happened, or expected, which is forward-looking. A lot of times we're going to be mixing up the two. We'll be saying, well, what happened in the past is my best estimate of what's going to happen in the future. And yet a good financial analyst is going to be looking at, prospects for sales, how well the company is currently run versus last year. So they're going to be making some adjustments. And most of the theory looks at the expected returns in the future, and yet most of the tests of the models that we'll talk about in this particular unit are tested using historical data. And so we may be actually talking, mixing apples and oranges here. Returns can either be expressed as in dollar terms or percentage terms. For the most part, we're going to use the percentage terms, but as I'm going to show, dollar terms are kind of an input. So for instance, what are the returns from an investment? Well, if we're talking dollar returns are just the amount of dollars we got. So for instance, if I invested $1,000 one year, came back the next year and sold it, and I was able to sell it for $1,050, then I made $50. That's what I'm talking dollar returns. If I'm looking at percent, then I'm going to have to take my $50 and divide it by the amount I invested. In other words, the percent returns are just looking at the dollar returns, $50, divided by how much I invested, $1,000. Or you could look at it, breaking it out and putting the actual definition of dollar return in the numerator, calling it dollars received minus dollars invested, divided by dollars invested. Either way, you're going to get 5% in my example, and so it doesn't really matter. Now that we've talked about return, we came up with this measure of return. What in the world is risk? Typically, investment returns are never known for sure. Even though somebody may promise you they're going to give you so much in a return for your investment, you never know what they're actually going to give you as a return for the investment. Therefore, when we talk investment risk, we're talking about the probability of earning a return different from that's expected. Usually we think of less than, and that's what it says here, but really what these models are tending to measure is it being different, meaning how uncertain am I of the results. That's really what we're talking about when we talk about risk. Most people can see that a high probability of a return that's far below the expected return is going to give you a great deal of risk, but it's going to be equally uncertain even if the possibility is for a great payoff. The difference, of course, is if I'm going to get a fairly normal payoff, unless things go really well, I'd tend to like that. That's a tweak on one of these particular models, but there is a model that handles that. So, for instance, which of these stocks is riskier? This is to make sure that we understood this from our stats classes. These are two normal distributions, and when I taught stats years ago, I had students who would call these the mustaches. Which one has more risk? The red one, stock A, or the black one, stock B? The answer, of course, is the black one, stock B, has more risk. Let me give you a made-up example. Let's pretend like we've done some analysis on 4 different stocks and treasury bills. That's what T-bill stands for. So with the treasury bill, if the economy goes in the toilet, that's what bust means, we're going to get a 1% return on our investment. If it's just below average, well, we'll still get 1% return on our investment. The average, here's kind of what we usually do in the economy, well, I'll still get a 1% return on my investment, and so on. No matter what, the T-bill is going to give me a 1% return on investment. If I have other alternatives, such as a company named FenceMart or Bronze Corral or Dread Healthcare or Moogle.com, you can see that I have projected different returns based on the state of the economy under 5 scenarios. Pretend with me for a moment that I also came up with some probabilities that any of these exist. Now note that the probabilities, 10%, 20%, 40%, 20%, 10%, all have to add up to be 1 exactly. Once I know all of this, then I can start to make some reasonable decisions based on how risky things are and what my expected returns are. And this is really where we're going with this first chunk. And by the way, the reason we're doing this is the way at least we got started thinking through how does risk affect return. So with this example, let me be more specific in defining and measuring risk. We've already mentioned all of the different possible outcomes from all those different investments. So if we say expected return, I'm going to define the expected return mathematically as follows. Expected return mu, or r hat, is equal to the summation of the probability times the individual returns. Just a sec, let me go back so you can actually see what in the world I'm talking about. So for instance, in the case of FenceMart, I have a whole bunch of different possible outcomes of returns. 2% under bust, 4% under below average, 7% under average conditions, 7.5% under above average conditions, and if it's a real boom, it goes back to 7% because people who were buying under above average now have enough money that they can buy. They can go shop in a really nice store. That's why I'm assuming that that's what I was thinking when I did that. So those are my R's. My probabilities are probabilities that that state of the economy actually existed. 10%, 20%, 40%, 20%, 10%. So returning to my definition, let me explain how I would figure out what the expected return is based on that. So my example, I would take the 10% probability, multiply that by the return expected under that scenario, the 2%, add that to the 20% probability for below average times the 4%, and so on. And once I make those multiplications of probability and return and add them all up, I'll get a kind of weighted average return. That's essentially all we're doing, which is 6% in this case. You could actually run through this and you'll find out that it is in fact exactly 6%. So my expected return is 6%. What's interesting about that is 6% isn't any of the options. If only those 5 things are possible, it's either a 2, a 4, a 7, a 7.5, or a 7%. I can't get 6%, and yet mathematically the expected return is 6%. It's the one right smack in the middle of all of those, weighted according to what is most likely based on their probabilities. If we go through and calculate it for all of those investments, then Moogle would yield the highest expected return of 7.9%. Dread Healthcare would be second at 6.4%. FenSmart, the one that we just looked at, would be number 3 at 6%. Bronze Corral would be 4.8% and in fourth, and the T-bill would be 1% and in dead last place. Now that we've figured out how to define and measure return, let's define and measure risk. The definition of risk that we've always used in finance, at least as a baseline, is the standard deviation. Risk in statistics, and especially in financial economics, is measured by standard deviation. It would be measured by variance, except variance would be in the units squared. In other words, in this instance, we'd be talking percent squared, which could be hard to figure out what in the world you're talking about there. So we take the square root of it to get the standard deviation, and in so doing, they go from percent squared to percents, which makes a lot more sense. So this is really measuring how tightly together all of the possible outcomes are. The wider apart they are, the more variation, the more risk there is in investing in that particular investment. So the way I would measure that mathematically is taking each of the individual returns, subtracting that number from the average, squaring that, multiplying that squared difference by the probability, adding all of those up, and then taking the square root. So this could be a mess. It's a lot easier to do in an Excel spreadsheet, by the way. So in the FenSmart example that we've already done, we're going to take the 0.1 times the 2, and in this instance, forgive me, I changed these from percent and I didn't want to put percent in the slide. So it's 0.1 times 2 minus 6 squared. By the way, it won't matter if we do the percent or we don't do the percent. The number in the end is going to be the same because it's a standard deviation. You may say, how is that possible with 0.02 and 0.06? When you square that, that gets to be a smaller number, not a bigger number. And 2 minus 6, and when you square that, that becomes a bigger number by squaring it. Yeah, well, when you take the square root of it, it kind of fixes itself. So don't worry about it. It's going to work. So the 0.1 times the difference, and notice how the second number in all of these parentheses is the 6. That's always the case because the 6% was the expected return. So once we crank through all of this one, by the way, we end up with 1.83%. How does expected return and risk look across our group here? Well, we have the standard deviation for Moogle.com of 9.19%, Dread Healthcare at 4.22%, FenSmart at 1.83%, the one we just calculated. Bronze Corral goes back up to 3.82%, and oddly enough, the T-bill has a 0% rate. This one's easy to figure out, by the way. For each one of those, you have to do the possible outcome under the different scenarios minus the average, square it, multiplied by the probability. Remember, under the T-bill, we were, no matter what happened, we were going to make 1%. So it's 1% minus the average. Well, since that's the only thing that could happen, that is the average. So it's 1% minus 1%. That's 0. Square it. Well, it's still 0. Multiply it by any probability, and yeah, it's still 0. Take the square root of it. It's still 0. Okay? So that's why that one's 0. If we're looking at just one particular thing that I can invest in, instead of a group of things, because if I can get a group of things, we're talking portfolio theory, and then the portfolio theory is a little bit different from standalone risk. So let's first talk standalone risk. So standalone risk, if I'm only investing in one thing, instead of an entire portfolio, then the biggest and most important concern to me is the standard deviation, because the standard deviation measures the standalone risk of any investment. The larger the standard deviation, the higher the probability of not getting what I was expecting. However, I should be taking into account the expected return too. So is there a measure that will take into account the standard deviation and the expected return together? The answer is, of course, yes. If investors have invested everything in one investment, then standard deviation should be standardized by the expected return, meaning divide the risk by the return. That measure, by the way, is called the coefficient of variation, or CV for short. So if the 5 things that I just talked about were the only possibilities and I'm looking at standalone risk, then we have Moogle.com that has a CV of 1.16. That one's the highest one. And remember, with CV, we're looking to minimize the risk. And risk is in the numerator, which means the smaller the CV, the better. So if I'm really risk averse and I want to just get rid of all my risk, this looks like the best thing for me to do is take that T-bill. However, if I'm interested in some risk so that I can increase my return, because 1%, really? That's all I can expect. Whereas the expected return on that Moogle.com is 7.9%. That's actually pretty good. But the CV is telling me that it's riskier. Oh, darn. Which brings us to portfolio risk and return.